In this video, we're going to look at monetary policy sheet. We're going to look at what we do, or what the Federal Reserve Bank would do anytime we have inflation. So that means price levels are high prices. So we want to slow the economy down. So I'm going to use a red pen to show a contractionary policy. We want to bring down inflation, and unfortunately, the way you do that is by not making GDP. So the Federal Reserve Bank can sell bonds to make small bucks, and we have a small money supply that actually makes interest rates decrease. That makes interest rates go up. So they can sell bonds or take the reserve ratio and raise that up. That's going to lower excess reserves, so then banks can't loan out as much money. I'm going to take the discount rate and raise it, or take the Fed funds rate and raise that. So these two rates are how, this one is where the discount rate is the rate at which banks can borrow from the Federal Reserve. The Fed funds rate is the rate at which banks borrow from each other to cover overnight loans and things like that. So if those interest rates are raised, the target interest rates would go up as well. Now I know that there's an inverse relationship between interest rate and bond price. So bond prices would drop as interest rates rise. So as there's a little more risk, there's not as much risk for a little bit bigger reward. So if the nominal interest rate is increasing, then I know if I have R equals I minus pi, and that one's going up, okay, if that inflation is still there, then we're still going to have the same rate. So both my interest rates are high. Consumption and interest-sensitive consumption, or investment, purchasing of capital, is going to decrease. So if I follow this over here, we're looking at aggregate demand based on consumption and investment changing according to that interest rate. So our capital formation is going to decrease. Capital is going to decrease. So the PPC and the long run supply are actually going to shift leftward or decrease, because that shows a reduction, or a reduction in our possible GDP we could make, our potential output. Now in the foreign exchange market, the good thing is people do like high interest rates who live in other countries. So what they would do is they would end up demanding our money so they can put it in our accounts to earn higher interest rates. So whenever that happens, that's going to make our exchange rate of our dollar go up. So if we follow our same formula, what happens when our exchange rate goes up is we become SID. That means that we have strong currency. Our imports will go up because goods and services in other countries become cheaper now. That puts us in a trade deficit. So if that's increasing, that's a negative. So that means our net exports is going to decrease. Net exports are a component of aggregate demand as well. So what we're trying to do there is we're going to try and decrease aggregate demand, decrease GDP, and price level. That's our goal, to make this price level bringing down inflation. So that's what we wanted, right? Our whole point is to bring down inflation anytime we have an economy that's suffering from high price levels. Unfortunately, what that's going to do is that's going to drive up unemployment, and that's our major side effect right there, is that we cause unemployment to increase. Now, expected inflation, as unemployment is going to be increasing, people won't be making things at work, so I can expect that inflation will remain decreasing in the future. Now, unemployment in the long run, of course, that's going to return to the natural rate anytime we have some kind of long run adjustments. Interest rates in the long run themselves, they're going to remain neutral. And remember, that was our big side effect. We cause some unemployment anytime we fix an economy with monetary policy that has inflation.